Welcome to the game called Life. Most of the time, we don't get to choose our characters. We work with the stats we are given and make the best out of our fortune. And sometimes, life throws us some good breaks. It's important to prepare for the future without sacrificing the needs of the present. What a bright choice! A lifelong financial partnership like the one Sun Life offers can guide you through your journey to financial security. We may not be able to choose where we start in life, but we can always find good allies on our side to strengthen our team, guild, or clan. They can lend us a hand as we go through our mission. We don't have a say on where we start off in life, but it's important to have a clear idea of where you want to go to understand what you have to do to get there. You will have many challenging encounters in life, and sometimes trustworthy allies come your way. You will also come across opportunities to gain experience and level up your skills. Because the more experience you gain, the easier for you to level up. You may encounter opportunities that are actually traps in disguise, so you have to choose wisely. Rewards feel good now, but you never know what will happen in the future. What are you willing to give up today to achieve your mission tomorrow? As with any game, it's best to save regularly. Life can be easy and it can be hard. It's best to prepare for the unexpected. An easy walk in the park can sometimes become an emergency at the blink of an eye. Be ready for anything. Life can be rough sometimes. It can throw curveballs at you. You never know when you might get into an accident. These things can deplete your savings and ability to earn money. Having an emergency fund and health insurance can cushion you from the unexpected. These backup plans can give you enough leeway to get yourself back in the game. Life is unpredictable. Saving is never enough. You have to be on the lookout for opportunities to grow. Sometimes you'll find opportunities but doubt if you should take the risk. Things may seem uncertain right now, but fortune favors the brave. You have to know when to take calculated risks. If you want to reach your goal, an emergency fund is not enough. With preparation, foresight, and a dependable partner, risks can pay off. You'll find yourself at a better position than where you were before. You've made a lot of progress. You've faced many challenges and gained a lot of knowledge and experience. Take this time to access where you are. Are you nearer to your financial goals? Talking with your allies and listening to good advice can help you form a plan on how to reach your goals. They say that when life becomes difficult, you are leveling up. Never lose heart. Keep going. As long as you live by the 7 bright steps, your character is sure to level up. With bright skills and a lifetime financial partner, you can rise together to a brighter world. Remember, you are the master of the game of life.
Welcome to our next session. Embarking on your journey as a first-time investor can be both exciting and daunting. Our next speaker will guide you towards first-time investor, long-term success. He boasts a distinguished career marked by over 15 years of expertise in sales distribution management, with a particular focus on investment and insurance products. Please join me in giving a warm welcome to the head of new market development at Sun Life, Mr. JJ Boak.
Okay.
Good afternoon, everyone. Good afternoon, attendees of the Money Summit 2023. If you're here, please let me feel you by typing emoticons or clicking emoticons here in the room. I know it's a bit rainy for certain areas, and classes are suspended today for certain areas because of Taal volcano, but I hope everybody here is safe. Now, what you can expect for my part would be I'll be speaking maybe about 30 minutes talking about the topic that you are seeing on your screen right now, entitled First-Time Investor Long-Term Success. I do know that there are attendees here this afternoon that are not first-time investors. Whether you are a beginner, someone who's been doing this for quite some time, I guarantee you there will be useful information, concepts that you will learn about investing, financial planning, that you can apply in building your portfolio as you grow your journey to wealth accumulation and income protection. Let me start this session by asking you a very important question. Guys, what is your definition of financial freedom? Take note that this is different for each person. Some people would say, I am financially free if I no longer need to work for the rest of my life. Others would say, I'm financially free when I already own 10 houses, 5 luxury cars, etc. I'm financially free when my family is well taken care of. It's different for each person. If you have a writing material or you have a cell phone with you, try to type it down. Why? Because it all starts by identifying what your objective is. Now, to guide you and to inform you on what the answer to this question is about, for some people, and if you Google it, there are hundreds of answers. I'd like to show you some of them. According to Susie Orman, financial freedom is about having your heart and mind free from worry about the what ifs of life or the uncertainties of life. I don't know if many of you know her, but she's definitely one of the popular public figures that we have. An author named T. Harv Eker said his definition of financial freedom is the ability to live the lifestyle he desires without having to work or rely on anyone else for money. Just like what I said earlier. Now, this guy may be known to some. One of the more famous authors, Stephen Covey, he said, your economic security does not lie in your job. So it doesn't depend on your job. It lies on your own power to produce, to generate income, to think, to learn, create, adapt. That's true financial independence. It's not about having wealth. It's about the power to produce wealth. So for Stephen Covey, if you're not producing wealth, not generating assets or money, you're not going to become financially free. Do you have the same definition? Now, the last one maybe is the most popular among the four. This is the author of the Rich Dad, Poor Dad book, Robert Kiyosaki. And to him, financial freedom and great wealth is a person's ability or skill to convert earned income into passive and portfolio income. Now, I'm going to use that as a segue to the next slide, taking off from the word portfolio, right? Now, people need to build their portfolio, their financial portfolio. That's what I'm talking about here. As we progress in life, you may have seen this pyramid elsewhere in the internet, maybe in other events, but I'd like to share my take on this. Whenever you are building your financial portfolio, you need to start at the bottom. It's like building a house. You need a solid foundation. And the foundation should be the color brown below. Cash flow and basic needs should be covered, right? meaning you should have ready access to money to buy food, pay for the expenses of your house, transportation, and your daily expenses. Now, I see a lot of people swiping the said basic expenses in their credit cards, meaning to say they don't have the ready money for it. So that's a problem. And yet they're already starting to think about where to invest. That's not the thing that we're advocating for here. When you do have that cash flow for basic needs, then you start to think of building emergency funds. Emergency funds for some people would mean 6 months equivalent of their monthly income. And you start thinking of, if something happens to me, my family needs to be protected, my business needs to be protected, then that's the time you start of thinking of, should I buy insurance? Only then do you go to the yellow part of the pyramid, which is about accumulating wealth. For some people, it's about buying real estate properties, investing in the stock market, whatever type of investment instrument, mutual funds, UITFs. We'll cover some of them later. But my point of showing you this is that there is a proper step-by-step process to it. Because the road to financial freedom, this blue-green area, you cannot just jump into that. You cannot just start to think immediately about, how can I retire comfortably when you don't even know where to get the money to buy your food next week, right? Does that make sense, friends? Now, by the way, I wasn't able to tell you what I do for a living. I've been in the industry for almost 2 decades now. Hopefully, hindi halata yun. And my work requires me actually, to go full circle in terms of, I sit with investments people who manage billions of funds, fund managers. I sit with them and meet with them every week. I'm also part of the team that develops products, financial products for our company. And my role would be to help high net worth clients, meaning clients with substantial amount of money, to manage their portfolios and grow it over time. Okay. And also, I go alongside financial advisors, distributors, to help them explain products and review financial portfolios. Just to give you a picture of who's this guy that you're listening to. No? So I would tend to be able to answer inquiries about products, instruments, what clients are going through, people who are selling products are going through. So all of those spectrum. And what you're hearing from me comes from almost 2 decades of experience of being on the field, not just stuck in the office behind a computer. I literally go out on the field almost on a daily basis, being with clients and people who sell products and the people who manage and develop products. So that's my point. So the point here is that you don't jump from one area right away. Like, I'm in my 50s and I want to leave a legacy to my kids. Gusto ko silang pamanahan. You don't jump to that right away. You secure each layer that you are seeing here. That's why it's called hierarchy. Now in Sun Life, in our company, we have this thing called life stages, which you can see down below. In life, you can be getting started, already moving up, preparing ahead, or you may be able to leave a legacy already. Some people may even attach ages to each life stage. Example, for getting started, that could be for guys who are in their 20 to 30 years old, moving up 40 to 50, preparing ahead 50 to 60, leaving a legacy if you're 60s and above. What I want to say though, is it's not automatic. Just because you're 60 years old, you're already leaving a legacy. You know, in my experience, there are good experiences and there are certainly bad experiences that I get to see from clients. No? When I say bad experiences, one of which would be meeting a 60-year-old retiree who is only getting started. No? Quite sad, no? I always get invited to companies to talk to people who are about to retire. They are given a certain amount of money by their companies, let's say 5 million pesos in my example. And it's a 60-year-old employee. And he said, JJ, can you help me manage my 5 million so that it lasts for the rest of my life? that's almost impossible, right? He's only 60. The average mortality age of a Filipino person this year, 2023, is 78 years old, right? And that we're only talking about 5 million. So the problem here is that he got started at a very late age already. And as you can see, for certain life stage, there should be certain financial goals that already needs to be set up. Like if you're getting started, you have to start with an emergency fund. The assumption is you've taken care of your basic needs already. So you can set up your emergency fund. Then you start to think about insurance. And only then you start to think building funds for the education of your kids if you have kids. Saving for milestones like for travels, etc. And just scan through this slide from left to right. No? So there are things that you should be taking up. So I want you guys to ask yourselves right now, what life stage am I in based on this slide? Are you already moving up? Are you preparing ahead? Or are you about to leave a legacy? Or whatever age you are in right now, are you just getting started? Which is fine. In fact, the title of my talk is First-Time Investor, Long-Term Success. If you're a first-time investor, then maybe it's just the start for you. Hopefully this helps. Now, there are two major things that affects a person, okay, in his or her drive to become financially free. One is to build his or her portfolio. That needs to happen, no? Portfolio development, no? The other one is portfolio management. So those are two different things, no? You have to build your portfolio, and I believe it's a lifetime process. Not because you bought 5 stocks, 2 mutual funds, 3 insurance products, you're done, you're well taken care of. No, that changes as you progress in life. And once you are building your portfolio already, you need to manage them properly, regularly. Now, the definition of portfolio management is also different for every individual, okay? But essentially, it's just balancing risks and reward. Asking yourself, how much risk can I afford to take in view of the returns that I am going for? And you will see the 4 factors of a profitable portfolio down below. Some people, and this is normal for those who are starting, and I would say, I see this often, people would go for instruments that would tend to give them the highest return. No? Return on investment, nandun yung focus. Unfortunately, they fail to consider the equivalent amount of risk that comes with it. No? You saw a stock go up by 30%, okay, in just a period of 1 month. You have 10 million, let's say you put all your 10 million there. Then suddenly after 2 weeks, it goes down, it becomes negative 20, right? So what I'm trying to say here is you need to consider all of these 4, not just the return of investment. Diversification is something that's left out by some. All of your money, they're placed in the bank, no? That's common for Filipinos, no? Some businessmen that I know of, 90% of their money is in their business, or 70% of their investment is in real estate. So as you know, as some of you may know, not all of these investors would be going up in a straight line. In fact, definitely, I will show you later that each asset class will have their good days and bad days. Or to be specific about it, good years and bad years. That's why you need to diversify, right? And as much as possible, you should be able to have a view on more or less what are the returns that you are expecting. And when I say returns, I'm not only talking about positive returns. Also know the potential negative returns or the downside risk. Is this asset that I'm buying, does this have the potential to become negative 20? Yes, it can become positive 20, but can it become negative 20? Factor that in, right? There has to be asset allocation. The ones that you're seeing on your screen are just the very common ones, like stocks for the more aggressive ones, bonds for the conservative investor, Real estate, I would say that's a traditional asset class. And of course, cash. Cash would pertain to savings accounts, checkings, and time deposits. These are cash equivalents, right? So you need to have an asset allocation mix. And to dive deeper on that if you will see on the screen, you would see the three asset classes that I mentioned, but the new one here would be the one to your lower right, which are the alternatives. When you say alternatives, you now see there hedge funds. Do you have money in gold? No, I'm into collecting art. No, art has been appreciating very well. Cryptocurrency is a topic here in Money Summit. It's very good to have all of these from a perspective of diversification. What you need to know there is what are the corresponding risks and time horizons that each asset class will expose you to, because certainly they're not all the same. And what I'd like to highlight on this slide, it's only cash, my friends, that has a low risk level. No? Some people would tell you this, and if you hear this, I suggest you run as fast as you can. If you hear someone tell you that, hey, I have an investment for you that is low risk or no risk, but high return, chances are that's a scam, right? Because there is such a thing as a risk and reward trade-off. That's a very basic thing if you're starting to think of investing. Okay. Even people who have been investing for more than 10 years, and I talk to them almost on a daily basis, have committed that mistake. Okay? Meaning to say, they were so attracted to the potential return and they missed out on the potential decline that they were caught off guard. And here they are 10 years after saying that if only I knew, I would have been more conservative in my asset selection. I'm not going to name certain assets, but well, I guess you know some of them, right? You know that markets would tend to go up and down, both the stock and bond markets. What I'm sharing here is that know the risk level, know the corresponding time horizon. Only cash is low risk and short term. In the same manner, if you're 30 years old and you're preparing for your retirement at age 60, you still have 30 years left. Do not leave all your money in cash or majority in cash, because obviously you have time on your side. So you now have the capability to expose your money to riskier instruments, which should give you higher potential returns. I also talk to some people who have a lot of money, who are still young in their 40s or even in their 50s, but by nature, they are very conservative. So you cannot force them. So what's important to do is to know your risk appetite and match it with your investment objectives or financial objectives. So with all of the uncertainties that we go through on a daily basis, how can we have this thing that we call money for life? I mean, money is not evil. In fact, the thing that money can do for people to help people live better, help other people, help institutions, organizations, it's very good. How can we have this for the rest of our life? It will only happen if we make the right decisions when it comes to building our portfolio. And again, I would have you start by identifying your risk profile. What I mean by that is ask yourself, what is my willingness to take risk and what is my ability to take risk? There is a very big difference between the two. I'll tell you this. There is a person who has 10 million pesos and he says, JJ, I have 10 million. You can invest it in the stock market. Okay. I don't mind. But the thing is, I need it in the next 6 months. I need it to become 12 million to grow by 20%. What is his scenario? That person is definitely willing, but he is not able What do I mean? The fact that he needs the money back in 6 months with a 20% gain, that means he's not that capable and able of investing in a risky instrument. On the other hand, I would have clients, and this is a true story, napahiya na ako dati when I was very young into this industry. No? This is a 70-year-old man wanting to put 100 million in Philippine equities, Philippine stock market. And I told him, because I only knew the basics back then, it was age. No, there was a rule that your age would dictate how much exposure you should have in the stock market. The older you are, dapat mas konti na. And I told her, sir, you're in your 70s, and I suggest you don't put the entire 100 million in an equity fund, no? Which will put your money 90 to 100% in the stock market. And you know what? He corrected me. Said, JJ, that 100 million is just a fraction of my money in the bank. Just go ahead and put it there. I don't mind if it goes down by 20%. That person is willing and is able. I share those stories because it allows you to better understand what do you now have to do. Internally, ask yourself, number one, am I willing? Am I conservative, moderately aggressive, or aggressive? Number two, what's my ability? No. If I expose a certain amount of money in a risky instrument, do I still have enough for buffer? No. Hindi ba magugutom yung pamilya ko? Am I gonna be taken care of in case someone gets sick? Do I still have an emergency fund? So you need to do asset allocation. It's about combining assets that will allow you to achieve your financial objectives, right? Subject to the risk that you are willing to take. Now, let's look at some examples here. And here in Sun Life, we always want to simplify things. If you're a conservative person, these are more of general rules. No? The asset allocation mix that you can apply, 80% of your money you put in bonds and money market. These are your conservative instruments. If you recall the slide that I showed a while ago, 20% is the one that you expose in stocks. I know many of you here would know mutual funds, UITFs, VULs. I'll talk about them later. And you can use those instruments to apply these asset allocation mixes. If you're a balanced type of person, obviously it's 50% bonds, 50% equity. And if you're aggressive, you can do the reverse. 20% bonds, 80% in stocks. But the point here is that you should have different types of assets in your portfolio. I've met a lot of people wherein all their money is in stocks. There are a lot of equity funds, mind you, and they are all different in terms of investment philosophies, but all of them are stocks. And when clients tell me I'm well diversified because I have 10 different equity funds, but sir, that's all in equities, right? If the Philippine stock market goes down, I'm pretty sure all of them will go down. None of them will be saved. They will just go down in different levels. Do you follow me? And that is when you will appreciate that, oh, buti na lang bumili ako ng real estate. Buti na lang I bought bonds. Good thing I have money in cash or in money market. You get me? I'd like to show to you the actual experience for the past 15 years of the VUL funds of Sun Life. And this will drive down that message. To your left would be the most conservative asset allocation, putting 100% in bonds. To your right would be the opposite, the most aggressive, putting 100% in stocks. Now, common person would say, hey, JJ, what instrument do you have that will give me the highest amount of return? No, potential highest amount of return. Then instantly the answer would be 100% exposure to equities. Because for the past 15 years, the highest 1-year return on a daily basis it grew by 72.2%. 10 million became 17 million, right? In a year. Unfortunately, if the client asks further, so what's the downside risk? Well, sir, for the past 15 years, it also went down by negative 43%. Now, some clients would take a step back already. And they will realize, I can't afford a negative 40% performance in my investment. And that actually happened in the pandemic year of 2020. The Philippine stock market was around 7,600, 7,800. After a month or two, I'm talking about January 2020, by March 2020, it went down to 4,600, cutting money almost into half. Then people were like going mad and panicking. And what do I do now? That only means they overexpose themselves in terms of risk. Now, let me show you this bar. Take a look at my cursor, the fourth bar to your left. Okay. Here you see a mix of 70% bond, 30% equity or stocks. What you should note are the numbers in between. By the way, the green numbers are the highest one-year return for the past 15 years. The red numbers are the worst one-year return for the past 15 years. And the number in the middle would be your average annual return for the past 15 years. Going back, for a 70 bond, 30 equity mix, the actual average annual return was 5.9% a year. If you compare that to the average annual return of the most aggressive mix, which is 8.3, we're talking about experiencing at least 70% of the annual return of the most aggressive mix while only having 30% exposure to stocks. Do you get what I mean? The message, my friend, is that you don't need to risk all of your money to grow it significantly. If you're the type of person who's happy with a 6% annual growth of their money, and that would be me, that's my magic number. If my money grows by 6% a year, I'm good with that. But guess what? I've been able to grow it by more than that every year, so I'm happier, right? So it's always about setting your expectations when it comes to returns, and your risk-taking ability should match that. Okay, so again, based on my example, you only need to set aside 30% of the money in the stock market according to this historical performance chart, while experiencing 80% of the annual return of being 100% in the stock market. I mean, this person to the rightmost would have sleepless nights when his 10 million falls down to 6 million, thereabouts. Now, it doesn't have to be millions. Don't get me wrong. Like, there are investment instruments that would allow you to open for 100 pesos. I'm not kidding you, right? So it really depends on you. I'm just talking about concepts here. Now, let me show you guys all the reasons to not invest. I repeat, all the reasons to not invest since the year 1999. Why? Because on your screen are the global crises that the world has experienced. To your left. Now, to your right would be their cumulative returns as of February of last year, fairly recent, if you invested your money in 60% stocks or equities and 40% bonds. No? I didn't say 100% equities, 60 equity, 40 bond, or what we call a balanced fund. Okay. Now you would see here that despite all of these financial crises, okay, significant pa rin yung gains, cumulative. Okay. So what does this mean? It proves the asset allocation scenario that I'm saying. Now this slide would show you that there is no asset class that would tend to perform and would be best year in and year out. If you follow the violet square here, commodities, to your top left in 2002, that was the asset class that best performing. If you put all your money there, like some people would tend to ask, what's the best performing now? I'll put all my money there, which would be wrong. You would be in deep trouble on the years of 2011 to 2015 because they're the worst asset class. I'm talking about commodities. It's starting to go up in 2016, 2019, 2021, and guess what? 2022, they're one of the best asset classes, while stock bond markets were doing very bad last year. Now, if you buy into a pooled fund, what I can say is that you get, for the most part, majority of these asset classes. So we now go on to the discussion of financial instruments. Now, in Sun Life, we have what we call the 4 pillars of financial security. We help clients with their goals to have liquidity, life and health protection, accumulating wealth, and transferring wealth, right? What I would say is that for each pillar, there are corresponding financial instruments. Now, we do have very limited amount of time. I know I've been talking for about 30 minutes now. Time goes by so fast. I'd like to focus on 3 things, actually on 2 things: mutual funds, VULs, and there's this one bonus later, by the way. First, mutual fund. What I can say about this is when you put money in a mutual fund, you're becoming a shareholder of that fund. Each mutual fund is actually a separate entity, a corporate entity. Now, you will choose whether you're going to be in a conservative, moderately aggressive, or aggressive funds. That would be your bond, balance, equity funds, and there are different types of that. How does it work? The investor will choose a mutual fund. You will get to participate in the movement of the stock and bond market. An asset manager would manage the fund for you. Then the money will be kept by what we call a custodian, and whatever gains and paper losses that it experienced, the shareholder takes part of that. That's the simple way of putting it. How does it earn? Let's say you have ₱1,000,000. There is a daily price, just like a stock, any given stock. There is a daily price. It's called the net asset value per share. Let's say the price today is ₱2. You have ₱1,000,000. 1,000,000 divided by ₱2, you get to buy 500,000 shares. And you let it stay there for, let's say, 2 years. After 2 years, the price per share becomes $250. So you deduct $250 from the initial purchase price of ₱2, you actually gained 50 centavos per share. Now, the magic or the final question would be, how many shares do you own? I said, when you buy into a mutual fund, you become a shareholder. How many shares do you own? And if it's 500,000 shares, you know that you're able to buy 500,000. Just multiply your gain with the number of shares that you own. Then you actually earned 250,000. Your 1,000,000 is already 1.25 million. You're up by 25%. And the good thing about that is that it's not subjected to a 20% withholding tax, unlike money in the time deposit, which is the more common instrument. All right. There's a request for me to talk about this particular instrument. Okay. I got this from their website. So if you want finer details, just go to the website of Pag-ibig. How do you differentiate mutual funds with MP2 and later on with VULs? MP2, as you can see on your screen, is a savings program by Pag-ibig, separate from their traditional savings program. It should give you a higher return. Take note, it matures in 5 years. The minimum contribution is 500 pesos. Now, I've highlighted in bold the things that you should take note of. Dividends are tax-free and can be withdrawn every year or after it matures in 5 years. Now, I tried to check what is the return, the indicative return. It didn't say in their website, only because I know for a fact it's going to be changing year after year, because it would depend on the income that is generated by Pag-ibig. So what is being said here is that the MP2 gives a higher dividend rate than their regular savings program. So it's all about diversifying, putting money here, putting it in mutual funds, in the stock bond market, or in this product, such as a variable unit-linked product. This product, compared to a mutual fund, would have an insurance component with it. Yes, it would allow you to put money in the stock and bond markets of the Philippines or even globally. Now you do have like what you call peso global funds. Your money is in peso, but it allows you to invest offshore while keeping you protected. The insurance component would help people with their wealth transfer needs, estate planning needs, and the like. Speaking of estate planning, as we speak, this is still at 6% of your total assets that you get to leave behind when someone passes away, right? It's 6%. And I'd like to mention this. This is by Attorney Cabrera, and it really communicates what estate planning and insurance is all about. He's saying that life insurance is one of the best tools to address estate planning, and I totally agree. And he said life insurance, and like estate tax, is triggered by death. When a person dies, estate tax becomes due. When a person dies, life insurance proceeds become due. So the timing couldn't be more perfect. Kung kailan kailangan yung pera, darating yung pera. And when you put in 1 million, when you put in 100,000, whatever that money is about, right? It doesn't get deducted, and it gets to be transferred to your beneficiaries, to your heirs, in the most hassle-free way, without being subjected to estate tax, if you assign your beneficiary as irrevocable. All right? So I'm out of time. I'm not going to discuss certain Sun Life products anymore, but I will be stopping and leaving you with this one. The essence of investment management is the management of risks and not the management of returns. I will repeat that. The essence of investment management is about managing your risk, and it's not all about managing returns. Some people would think, oh no, my portfolio is like only up by 2%, or my portfolio is down by 10%. No. So it's not about the returns. It's about rebalancing your portfolio and managing it on a regular basis so that whatever happens, the risk component of that portfolio still matches your current risk profile, because risk appetites change over time, but goals also do change. But in terms of attaining goals, that question needs to be addressed by everybody. We all need to meet our goals. And in order to walk that path, we need to know what assets we should be buying. That's portfolio building. And how do we manage them properly as we go through our different life stages. So thank you very much for listening. And I will now turn it over to our coordinator or host for our Q&A. Thank you very much, guys.
Thank you, Sir JJ. This is really a good session for first timers, address to all first timers, and I believe this is also good for everyone. Just a background or just a refresher for everybody. Sir JJ, I have a question here. This is really interesting. What percentage of our savings or income is recommended to invest as a first timer?
Okay. So there's no specific percentage there, as you may know. It differs from one person to another. When you say savings, again, I will reiterate or repeat, that's already excess of all the basic expenses that you need to cover, right? Only then, if you think you're not going to be needing that money, here comes the next question. For how long? Will you need it in the next month, in the next 6 months, 1 year, 5, 10 years? Okay. Because my answer to the first question is, okay, now you can invest that money. But the next question, again, the second question is, where do you invest it? Do you invest it in a short-term, medium-term, long-term instrument? And then there's a third question. Okay. We've addressed, do I invest it? How much? Okay, whatever is left after you've taken care of your basic expenses. Okay, how long do I invest it? Okay. Where do I invest it? That's the third question. Okay, what type of asset class? Right. So I hope that helps. I gave more answers than what was asked, but I'd like to provide a more complete answer. As long as you feel that you don't need that money for important expenses over the short term, then you can invest it. In fact, you can put it in a money market fund, which allows you to, like in Sun Life, it only takes a day to withdraw it back. If you keep it for a year, usually the growth is like between 1 to 3%, historically speaking. So it really depends on when you're going to need it. And then what's your risk appetite for these things.
Perfect. Sir JJ, one more question here. You mentioned a while ago about following a financial planning pyramid. Yeah.
Yeah.
Can someone just do it can it be done simultaneously, like in saving for education and emergency fund at the same time?
Um, if the question is if it can be done, the answer is yes. If the
Mm,
question is should I do it one at a time, I would say yes to that.
mm,
Right? Because once you've set up your emergency fund, I don't know if many of those who are listening here have set that up already. It removes a big burden on your chest that, if I suddenly lose my job, if someone gets sick, if a relative comes to me and needs money, there's that something that you can draw from, right? So I would say build that first. Like for the next 6 months, we're talking about 1 month income times six, right? For the next 6 months, build that up. You'd be surprised how much happier you'd be, how much confident you'd be walking around, right? Then you start setting aside money for child's education, right? So it's really a step-by-step procedure ideally. I know some people would tend to just jump right into it, do several things at the same time. But if you're asking my advice, again, follow the pyramid.
follow the pyramid, folks. So JJ, I think this is a good one also. What is the right mix, if you will recommend a right mix of investments for people for this specific question in their 30s?
So, like what I said earlier, it's not about the age. It's not about how young, how old you are. The mix would depend on two things. What is your risk appetite? Number one. That instantly will tell you how much money can you afford to be put in a risky asset class, such as a
Mm,
stock fund, an equity fund. And all the rest you put in a more conservative instrument, such as a bond or money market, or
mm.
even cash. So identify your risk profile. And number two, what is your target return? Like what I said, that those two things should match. Like if you're targeting to have 10 million pesos 5 years from now, you can't also just put your money in bonds because and if you only have, let's say, 5 million pesos, you can't expect bonds to double your money in 5 years, things like that. So you need to, instead of looking at your age, look at your risk appetite and then match it with your target return.
That is a good suggestion. Well, I have your last question, Sir JJ.
Mhm.
This is somewhat tricky. Um, how can he move forward from disappointment because he has entrusted fund managers? There's been disappointment. He has been in Sun Life. Based on the question, invested in mutual funds, UITF, VUL, and some stocks, but returns are very disappointing. So, how would you advise him on moving forward from
Sure.
disappointment and
Yeah.
whatnot? Yep.
Great question. And you know what? I encounter that question literally on a daily basis. You know why? The Philippine stock market is down to 6,000 level, lower than where it's at 10 years ago. And I also have money in the stock market. So, I can fully sympathize. And this is how you should move forward from it. Okay. It's all about portfolio rebalancing. There are several ways. You can do number one, peso cost averaging. What does that mean? You buy assets while their prices are lower compared to their initial selling price. If you were buying into the stock market when the level was 7,500 and now it's 6,000, you put in the same amount of money. What were you able to achieve? You effectively lowered your cost of investment. Let's say you bought it at 2 pesos. Now it's being sold at 150. Same price you put in, 1 million, 1 million. What's your average cost of investment between 2 pesos and 1 peso? Your average cost is 150. You've lowered it. What's the effect of that? You now no longer need to wait for the market to go back to the previous level when you bought. You just need to wait it out until it surpasses 150, then you're break even. Do you follow? It allows you to break even faster, and it allows you to recover and earn faster. Rule of averaging down. Number two, a lot of people would realize that only when they're finally experiencing significant paper losses that I'm not the aggressive type. Then you change your portfolio. You put in more products that would give you guaranteed payouts. And now there's a lot of that in the market. I don't want to mention these instruments because it's not part of the talk, but there are a lot of instruments that really give you fixed annual payouts, which would remove the uncertainty, right? Because the instruments that were mentioned were mutual funds, VUS, UITFs, all of them would have uncertainty with them, volatility, right? You buy products that would give you fixed annual payouts, then you will recover at a certain pace in a fixed period of time. That's how you recover. The first one, law of averaging down, you're not changing your risk appetite there. You're still being aggressive. You're just buying when it's low. In fact, that's what fund managers do. When this stock goes down and we know it's a good brand, it's a good company, earnings are good, it's just that people are risk off now. That's why they're going out of the market. I'm going to buy more of that, right? So it's a cycle, guys. Markets will eventually recover. Some people are willing to wait, some people are not, right? So there are ways that you can do, like buy while it's low. If it's lower, buy some more. Or if not, you change your portfolio. Buy more of the guaranteed paying ones. Assets, I mean, right?
Perfect. Sir JJ, thank you. That was really good. I hope everybody, especially the first timers, are able to get insights. And that concludes this session. Thank you, Sir JJ. Everybody, please exit this session and see you on the next one, next agenda. Agenda, next session.
Thank you,
Heart to
Mayor.
heart. Thank you,
Thanks,
Sir
everyone.
JJ. See you
Bye.
there. Bye.